Hi, everyone. This is Rick Bensignor. Welcome to this week's In the Know Trader Show. To start things off, let me tell you that I've been asked to speak at this Friday's New York Behavioral Economics Forum at the CMT Association's annual symposium. I'll be giving a talk on behavioral finance theory, what it is and how it relates to decision-making in the markets. And I'll also share just one of several ways I've determined how to incorporate behavioral finance into the actual timing of market analysis and decisions. There's still time to sign up for that. They're actually running a special. It's a due-day conference, and the behavioral finance part of it is on Friday only, so they have a special low price for people who come just on Friday. So if you're in the New York area or have a chance to get there, go to the CMT Association's website, and I think it's cmtassociation.org, if I recall, and check it out, or behavioraleconomics.com, and you can look and find out more information about it. And again, still, I heard there is just a few slots left, and so there is some availability to get to it. The next thing I want to just talk about as we start off today is talk about what I'll call the bear market argument. Is there really one to have? And I think about how long are bears going to carry on that we've been in a bear market and continue to be in a bear market rally. When the market continues to rally like it is, the S&P is about 2665 as we record this, and that means that we're only about, I don't know, just over 2% from all-time highs. And yet I still see with consistency people fighting the whole idea and have missed this year's dramatic up move. And not only have they might have missed it, but more often than not, if they're vocal bears, they've actually been short and therefore losing money. And I think about this in just not market sense terms, but also in behavioral finance terms, and think about all the biases that anyone has and just how dogmatic they may be about insisting that they're right, as compared to simply accepting that, hey, you just might be wrong, and that a market that has moved this close to all-time highs, that for perhaps, 2 days was listed as being in a bear market by having declined by 20% from its all-time high. So 2 days, let's say, in bear market and hundreds of days not in bear market. You tell me which one's right. And I'm amazed when I watch CNBC and Fox and Bloomberg, and I still hear people fighting this and always looking for the next level of resistance to lean against and sell into. We've made it very clear. I've told you this before, but I'll mention it again because I know every week we've picked up quite a few new listeners. And when I say quite a few, it's often in the neighborhood of hundreds each week that we're picking up. And the December decline in the market is what seems to have fooled most people into thinking that we got into a bear market. The NASDAQ got down 23%. The media tells you, oh, bear market, we've hit these key numbers of 20%. And as I've said before, if there's anything you can learn from what's gone on since the December decline, it is, one, do not necessarily in any way, shape, or form pay attention to what people say on TV as being gospel. Number two, this whole concept of a supposed 10% correction and 20% movement to either start or define a bear market, or to also define a bull market off of a 20% move off of a low. is a pure, untested number that someone in the 1980s came up with, having worked at a Wall Street firm, simply written a research report and used those general numbers of, hey, if a market pulls back 10% from a high, you're kind of correcting. And if it pulls back 20% or more, it is defined as a bear market. And that concept kind of, I'll say, spread around the street, and people referenced those numbers as being such. But there is no hard and fast rule of what defines a precise amount that a bull or a bear market needs to move from prior low or prior high, respectively, in order to call it a bull market or a bear market. There are several ingredients involved, none of which of less what percent you've moved from a high or a low is just perhaps one of many elements one need to look at. And again, even from the simple example I gave you of what occurred around Christmas time, where it was literally just a couple days that the S&P was down 20% from the high, to then think, okay, this is the now that we've moved 20% and you're first calling it a bear market, which also means you've missed a dramatic amount of the decline before you even called it a bear market, and now it's gotten so many people bearish simply because some target level was hit. The amount of time it's spent there is so remote, the price action since so obviously bullish, that it really behooves me to think that there are so many professionals out there on the street who continue to call this a bear market, or are first now starting with the S&P north of 2850, are starting to say, well, maybe it's not, or maybe it's just part of a sideways consolidation, in my eyes, this was nothing more than a decline that was sharp and hurt some folks, but stopped where it needed to on the downside, has recovered dramatically since. And this is nothing more than the general ongoing bull market that we have seen for years in, let's just say, in S&P terms. And the amount of time, again, even the decline in 2016, which was a sharp decline. And at the time, I did get publicly bearish and was on CNBC looking for a much bigger decline. The market quickly told me I was wrong. And if you're a good analyst, strategist, an individual investor who's watching your own money and kind of taking care of your own investments, listen to what the market's telling you. And the market clearly has spoken since the day after Christmas, including a 1,000 plus point rally in the Dow and over 100-point rally in the S&P immediately after Christmas, that there is substantial reason to doubt this whole bear market scenario. And lots of people on the street have said it's, what do they call it, a dead cat bounce, that, you know, whatever we saw was a quick reflex rally that you often see in bear markets. Well, the fact is now that the S&P is 2% from its all-time highs, how do you argue that you're still in a bear market? And the way I look at this as a behavioral strategist is that you're simply behaving more like, I'll say, even a child who just wants to be stubborn about something, and regardless of the facts in front of them, they're going to cling to their position because they have a tremendously difficult time simply admitting they're wrong. And this is, in fact, something I'll be talking about in Friday at the Behavioral Economics Forum in New York, is people's clinging to calls that the market is telling them is not correct. And there's a real psychological element involved in this, which is why More and more people need to understand behavioral finance. More financial advisors need to understand behavioral finance, so they themselves can better interact with their clients, because they themselves have biases about money, about decision making when it relates to finances. And if you've got yourself a financial consultant who's not well versed in understanding their own biases, then it's certain those biases are going to show up in how they advise you and what to do with your money. So that's almost like going to a therapist who hasn't themselves gone through a tremendous amount of therapy themselves. And anybody who's certified as a therapist has to go through a ton of therapy themselves with somebody kind of higher up the food chain during their schooling, because they've got to make sure that their head is clear and unbiased when they're giving advice to people who come to them. And it's really no different when you go to a financial advisor. You want to make sure that your financial advisor is well versed in behavioral finance, has taken courses. Hopefully the firm they work for has invested in this area. And this is, some of the type training and corporate training I do, is I go into firms and I teach behavioral finance to their financial consultants, and make sure that this whole understanding of how much psychology plays a role in how you think about money and the decisions you make, and as a financial consultant, how it affects your clients. This is a big miss by those who are still on the financial consulting side, who are not taking the opportunity that is out there through firms like myself or other firms that will help better understand all the psychology that affects the decision-making process. So in a nutshell here, I'll stick with what I said since early January. In 2018, the US was not in a bear market. This is not a bear market rally. And we have not been in a bear market in 2019. And I tend to think that we will not at all see a bear market in 2019. Now, that doesn't mean, and here we'll kind of flip to some of the key charts. So let's start off and move to the S&P. This doesn't mean that the S&P cannot sell off a couple hundred points at some point this year. It certainly could. But that's not going to put it into a bear market scenario. At this point, it would be hard to even think that we'd be in a bear market scenario if we didn't get beneath December's lows. And so for one thing, as a reference point, we know the market, and I'll try to, here, let me kind of put a little ellipse here. It'll make it easy to see. Now, this area down here, the December low and the final end of that kind of 2-week decline, is V-shaped. The market moved up virtually as quick as it sold off, and then it didn't consolidate. It just kept on going. So to even get the concept that sometime in the future we're going to be in a bear market, and eventually we will, but you've got to, the way I look at this, you've got to at least take out those December lows to even think that you could be in a bear market, unless the S&P makes substantial new all-time highs, in which case the lows near 2350 may be too low to look at before determining a bear market exists, but it's not simply a 20% move from the high. There are multiple components to that scenario. So if we look at the S&P now, let me identify a few things on this chart. For those of you who are get rid of that. For those of you who are unfamiliar with cloud charts, or what's called Ichimoku, I'll take them off for a second. So we'll look first at simply what the S&Ps look like with a bar chart, and then Tom DeMark's sequential model. And this model that I've described multiple times in the past couple months. In fact, for those of you, again, tuning in kind of for the first time, this model is an institutionally used model. The public has a very difficult time getting their hands on this model. It's not impossible, but it is definitely designed and priced for institutional use. And some of the most successful hedge funds and long onlys, in other words, like mutual funds that are basically long the market, this is one of their preferred models to get a sense of when trends are tiring and potentially indicative that the trend will stall or potentially reverse. The signals here that are the most important to look at are blue 9 counts, and in this case, both kind of deep maroon and bright red 13 counts. I'm not going to go through how those show up on the screen during today's talk, but I will tell you that if you go back in YouTube and do a search for In the Know Trader or Rick Bensignor, you will see that I did 4 consecutive weeks of StockCharts seminars on how to use this model. If I'm not mistaken, the first of the 4 was the last Tuesday in January of 2019, and then 3 more into February. So basically from late January to late February, you can find out much more about this model, the impact of it, and why it is one of the preferred institutional models that really gives an edge over standard models out there in the technical universe. This is much more about market timing than it would be thought of as a technical analysis indicator. It is really about a timing indicator. And when you see 13s show up on top of price bars, it generally is saying that within the current trend, and if these numbers appear on top of price bars, it implies that the market's been moving higher, and that this model suggests that when those 13s appear, it is typically a poor time to first be initiating a new long position in an uptrend. If we look at the 3 times we've seen some of these signals appear on the daily chart since the December low, you've got 13s in here. It went slightly higher. Oops, let's remove that. And then you sold off for a week. You've got a 13 showing up. It's either yesterday or today, which is one of the reasons why I've also cautioned clients to keep chasing after the market. I'm fine holding longs, but I don't want to keep putting new capital to work right now, simply because I rather ride profits that we have, and we got in, much lower because, again, here in early January, we had already somewhere, I think it was by January 10th or so, somewhere in here is when we had written to our clients that the lows down here in December were not just temporarily good lows, but actually the low to global equity markets. But not only did the S&P bottom out at the time, but so did the ACWI All World Index bottom out at that time. And equity markets almost universally have been straight up since then. So again, now when I look at the S&P, I'm just somewhat cautious about adding new long exposure. I'm happy to keep what we still have on. There's still some upside here. I'm not going to get materially concerned at this point until now the number has moved up to somewhere between 27.25 and 27.10, which is, let's say, this area. And here, unless we broke under there, I'm not really concerned about pullbacks. Now, at this point, that's over a 100-point pullback, so that doesn't mean I'd necessarily be happy to see the 100-point pullback. But I'm not concerned structurally about this move that we've seen off of the December bottom until we at least would probably play down into that level, which is essentially a test of the early March low, which held just about into that same level. On the upside, let's change the scaling here a little bit. We still have some targets above. If I switch this to a weekly chart, You can see back here in 2018, the 13 identified actually what at the time became the all-time high. You know, we sold off into February of 2013. We retested, we peaked on a 9, sold down to the 200-week moving average, and now we're back and starting to face some resistance. In the bigger picture, when and if we make new all-time highs, and depending upon how we make new all-time highs, I can ultimately put a price target much higher up here at about 34.77. And I'm not ready to, you know, go and say that's where we're going now. We certainly still could consolidate and spend time. But given the fact that I think the December sell-off was all part of just the bigger overall bullish market, at some point this year, as we, and if we break out to the upside, that will be a bigger upside target. Doesn't mean it has to be hit in 2019 either, but that's kind of what these models would indicate would come into play based upon, well, I'll almost say the physics of how the markets move. So yes, I continue to be a bull in the equity markets. Let me see here if I have the equity. If not, let's just add a chart here. Oh, hold on one sec. Let me do this. There we go. So this chart here, I'll blow it up. This is the All World Index ETF, ACWX. The X means exclusive of the US. So this is all the major markets in the world, exclusive of the US. If I put it to a monthly chart, and I draw a simple trend line from the debt crisis low, 2009, to the early 2016 low, first off, we see that the low in December and November, no, I guess that's December here, held above the long-term trend line. That's number one. Now, is that enough for me to come out with a call and say this low here is good and it's not just a temporary low? But no, it's not. If I put the sequential model on, I've now got a 9 down, which is 9 consecutive monthly chart, 9 consecutive monthly charts that the close was less than the close at month's end. So the last trading day of the month, the close out for the month was less than the close from 4 months prior. And when you do this 9 months in a row, you are often at a potential inflection point. We saw this exact same pattern bottom the market in 2016. We can see that it peaked the market. In this case, it's 9 consecutive months closed above the close from 4 months prior. Gave us the peak, and take a look at the massive decline we saw in 2011 after doing that pattern. And then we also saw a 13 come from above the price bars, a little early, not by much, but this is saying there's super high risk to playing the direction of the trend in the sense of adding more capital in to what has been a bull market. And certainly that worked out for 2 years. So let's go back to December. The world is selling off in 2018. The US didn't, right? We had the February sell-off to start the year, but then we recouped those levels. So on a monthly chart, I'm looking at this and saying, interesting, we're holding above long-term trend line. And I've got a setup 9 count, possible downside exhaustion. Flip it to a weekly chart, and lo and behold, the same time that the monthly chart had a -9 count on the setup, the weekly chart has a -13 count. So now I have 2 time frames that both suggest downside exhaustion. Now, we've moved up 9 weeks in a row since then. And if I blow this up, hold on a little bit so you can see it even more clearly. The 9th week actually ended up being a pretty decent down week. And again, 9 counts are potential shorter-term turning points. Doesn't have to be the big one, but it's certainly something we pay attention to. Back here, only thing, let's put in the ellipse there. So back here, it worked for a month and identified at least a short-term turning point. Here, back a few weeks ago, this 9 count, which is kind of this big dark candle down, we've been able to, next week we recouped, closed above it, down week, up week, and now we gapped up this week. So it's questionable right now if I really want to be adding significant long exposure, because I'm still within the context of the 9 count. Let's see, even on a daily chart, where this is. This is close to another 13, just like the S&P was. This 13 here back in February was a little early for sure, but if you had put money in then, you're barely making money now, and it's a month and a half later. So there are times that, you know, again, this is just one model. We don't base all our decisions on this, but it's certainly an important thing to look at in the scope of things. So now you kind of fully understand why I've been a bull since early January. Let me take a look. Let's take a look at a couple other charts while we have just a little bit more time to go. And the one I want to take a look at the most is kind of crude oil, because crude oil has moved very similarly to how the S&P has moved since October of last year. Basically, the stock market peaked out in and around October 1st. So did oil. Oil happened to do it also on a 13 signal. It bottomed a day, I don't know, what, 2-3 days, getting a 13 signal down here too, suggesting exhaustion of downtrend. And the charts look fairly similar in the sense that we've pretty much been straight up in both markets. And both are essentially on the highs of the move within the last 24 hours. In percentage terms, oil has moved much more substantially. And we're getting closer to, let's say, a 62% Fibonacci, somewhere right near 63.5 of the whole decline that we saw from $77 oil down to $42.5 oil. I'm starting to get the feeling that oil is, what I've written clients is, it's late in the ball game. I do not see oil getting back to 70. I could make the case for it to get to the mid to high 60s, but ultimately I'm going to start looking for places to sell oil soon. I simply do not have any thought that we are going to take out that peak near $77. That is it for this week. Again, it is amazing how quickly the time flies by. For this half hour. Again, if you're in the New York area, try to catch me Friday at the Behavioral Economics Forum. And thank you for tuning in to this week's In the Know Trader Show. I'm Rick Bensignor. Bye-bye.